Hey everybody, this is Ryan Mallory for SharePlanner.com. Today is June 27th, 2014. Doing another Hangout with y'all and going over today's market action, my thoughts towards the main indices, as well as some individual trade setups and how I'm managing current trades. So let's go ahead and start off with the S&P 500. Instead of looking right at the daily at first, I want to zoom back and look at the weekly chart of the S&P 500, and in doing so you can see we've got this long-term channel going all the way back to the beginning of 2012 that we've been trading in basically. And I think what has probably been making it difficult for the market to really push through this through the 1900s or through these mid-1900s and towards 2000 is the fact that on the weekly chart we do have some rising resistance. So each week it can move up a little bit more, but it's really struggling to push above that resistance or that rising wall that you have with the weekly chart here. And I mean, it's been in place since 2012, so you're talking about over two and a half years now that this wall has been in place, and so it is causing some trouble on the daily charts when we're looking at it. I mean, you can see it's not perfect, but when you look at it from the weekly, you can pretty much see what this market is trailing. So I think that's causing a little bit of heartburn for the market right now. How that doesn't mean that it can't break out above it. We've seen that happen in the past. With other rising channels where eventually the market gets enough momentum built up to where it can push through it and never look back. But on the daily here too, you got what I talked about in the trading plan this morning, a bullish flag that's forming. So essentially when you have a flag, it looks like it tends to happen after the market's rallied quite a bit, and then it consolidates sideways with a slight sell-off. So it kind of looks like a flag on a pole. So your flag happens to be this price action here, and so far we're maintaining that bullish flag pattern. And once it gets above, let's say it can close above 1959. Let's say it goes all the way up to like 1960 today. It'll effectively have broken out of the bull flag pattern, and that would bode very well going into next week. So being only like 3.5 points away from achieving that, it's very possible that we could see that today. However, momentum has been a little bit lagging today. We've seen 4 or 5 point sell-offs, 4 or 5 point rises, but nothing really sustainable at this point. Let's look at the NASDAQ too. Also, one more point about the S&P. I've been following this little short-term rising channel here, this one right there, and that basically connects it off of like the 416 lows and just connects it. We haven't challenged it, since mid-May, but that's something that you do want to watch going forward. Like today, that rising channel is at 1925, 1926. So we're about 30 points away from it, but if we ever do see some selling, you'd like to see the dip buyers come in at least at 1925, 1926, or whatever that rising channel or rising trend line is off of those lows on that particular day. Let's look at the NASDAQ now. You can see here the channel on the NASDAQ is pretty nice. I mean, it looks very solid, breaking out to new recent highs here. The key is getting back above those highs from late February, early March. It's done that, and this is probably one of the healthiest of all the charts out there right now. On the Russell, a lot of the consolidation that you're seeing on the S&P, except it's not happening near the recent highs. It's happening quite a bit below it. Nonetheless, though, the fact that it's still around that 1190 level, that bodes well for it going forward as well. So overall, you got the indices pretty much painting similar pictures here. You got the NASDAQ that's obviously the healthiest, the S&P followed right behind it, and the Russell or the small caps that seem to really be struggling the most right now in the market. But overall, the indices are indicating that there's more upside to this market, that it really hasn't topped out yet. And if we can confirm that bull flag on the S&P 500, I think it particularly sets us up well for going into next week and the week beyond. Now let's get into some trades. We had a bit of a sell-off earlier this afternoon. It took me out of one of my positions. I think this is only the second stock that I've been stopped out of this entire month, which is really good. I mean I've had some losers, but it's usually after I cut the trade short of its stop loss because I know at that point it's no good. But the KATE or Kate, whatever you want to call it, this is a little bit more of a volatile stock. I recognize that. It had a clear level of support, so when it was bouncing, let me get rid of today's action so you can see what I was looking at yesterday. This is what I was intrigued by yesterday. You see how you have a clear level of support, it breaks out perfectly, and then it has a light volume pullback to support, bounces. This was a great trade to take, in my opinion. Now, that doesn't mean it's always going to work out in the way that you expect it to work out, because it didn't in this situation. But it was the right trade to take at that time, except today it just didn't follow through and had some more additional selling lines. So I got stopped out at 37.64 for a 2.6% loss. I think 2.6 is probably the worst trade so far this month that I've had, which, when you look at it from the big picture, we have trades of like 9 and 10%, and everything else that's small time compared to the profits that we're pulling in. But Kate definitely had a different frame of mind than what I was expecting it to have coming into today. When we had a little bit of selling come in on the S&P 500, it ushered in a lot of selling pressure on KATE in particular. So out of that, we got out of it, and because and the reason why we got out is because it broke the support level that I was expecting it to hold. Once it does that, there's no reason to hold on to that stock anymore. It was a great setup that didn't materialize like it was expected to. So that said, you get out of the stock and you move on to the next trade. And when I get stopped out of a trade, I'll have it up on my monitor. I always have all my trades up on one monitor, and when that trade gets stopped out, it's closed out, and I take the stock off my monitors, and I don't ever look at it again until it pops back up into my screens again. I don't get emotionally involved in my trades. I mean, I expect that there's going to be stocks that get stopped out. We had a great month last month, but still we had 36% of our trades turn out to be losers, and 64% of them turn out to be winners. So you can't be right on every one of them. This is another good month where I'm hovering around that 60% accuracy level again, and but you're not going to be call every one of them right. The key is keeping these things so small, so tight, that the losses really are dwarfed in comparison to the profits that you make in trading. And that's really what I try to drive home to traders, and in particular members of the Share Planner Splash Zone, is that when you ferociously, I guess that's maybe the best way I can think of it at the time, but when you ferociously or diligently attack the risk on your trade and don't let it get away from you, then the profits are going to take care of themselves. They really do. I mean, manage the risk and the profits will come. So let's look at some other trades here. We got some really good gems in the portfolio today, Yoku being one of them. I don't see a reason quite yet. My opinion might change in the next hour and a half or so as we approach the close, but Yoku still is, I mean, it's trending perfectly higher, and it's broken this downtrend for sure. And I thought maybe we would see some selling today. I wasn't sure how much, or if it would just wipe out the gains from yesterday, but it's not. It's actually building on it. We're getting some follow through on it, and that's the best thing that we could be seeing out of a stock that just rallied 4% yesterday, is to get another 1% out of it again today. So excellent move out of Yoku. Now let's look at another play that we had, Triple D here. Another similar base breakout play. It broke out about 5 days ago. We got in on it on the 25th, so 3 days ago, and it's done great so far. We're up about 4% on that trade. Got in at 56.54, trading at 58.88, and this is another trade. I don't see a reason to get out of it at this point. I think it looks good. I think it has a more upside to it. FSLR. This one, I'm a little bit on the fence about. It had a nice afternoon pop yesterday where you could see it went way up there. I guess there was some news out of Latin America where there was a new solar plant, or the largest solar plant to be built there by FSLR. But it's really not giving us a lot of follow through here. You got a couple of long shadows here in the last 2 days, and one shadow I can deal with, but I start getting a little bit queasy when I start seeing multiple uh, upper shadows being formed on one individual trade on back-to-back days. So FSLR, definitely a little bit concerned with, but I'm going to wait about a little longer here before I decide formally whether to close it out or not. Then you got CX. CX is really an interesting trade. I've traded both I've traded multiple times this year with success and loss. But there's a lot going on here that can be discussed. First of all, you have a nice rising trend line that it's bouncing off of. Then you have a price level support here coming across that it's also bouncing off of. So there's two main levels of support that's holding this stock up, and I expect it to hold it up going forward. Now, you do have some resistance overhead, though. As you can see there, some clear resistance at 1350. My opinion is I do think it can break through it, but you know, obviously I'm not going to know for sure, but it's worth trading in now because we can keep the risk extremely tight, and then when if it does decide to break through that level, then we got in at a pretty cheap price. If we wait till 1350, then the trade is really away from us at that point, and there's no way to trade it and keep a tight stop loss on it at the same time. So with CX. I'm a little bit concerned we're not just, you know, hopping off of this trend line and off of this price level support, but I think at this point I don't think the trade is really being threatened or at risk of being stopped out. So I lean towards the fact giving it more time to see how it plays out. Facebook, FB. You know, here again, this is the stock that we've been holding the longest, and it's really not that long. It goes back to, I think, Monday. Monday we bought this stock, and it was a great setup. You had this little doji candle on Friday, and then it looked like it wanted to push back higher. We had traded it the week prior to that, and I think we might have made like 1.5% off of it. Not a ton, but it was profits. And but then it looked like it wanted to push back out again, so that's why I got long on it on Monday, and since then it's been going back up. Yesterday I was a little bit on the fence about this candle here. I wasn't sure, but you know, looking back at its history, it tended to still push higher, like what you see back here. You know, when it broke out higher and then gave up the gains, it still kept trucking along in the days that followed. So I decided to give it some more time to see if it can continue the uptrend. So far, it's looking like that was a good move. And so I think I could keep on holding on to that stock. So overall, I mean, it's a really good portfolio. I'd like to see a little bit more action out of the CX. You know, finally get its mojo. We've only held it since yesterday afternoon, but nonetheless, that'll be key for it in order for it to stay in the portfolio. It's got to do something for us. I'm not going to let it just lay stagnant, because then there is an element of risk that's associated with time. That the longer you hold a stock, of course, the more that can go wrong in it, right? Bad news, you know, somebody does a scandal or something, and it's directly tied to the company or the stock that you're trading, and it impacts your share price negatively. So the element of time is definitely a consideration. That if the stock isn't going anywhere, why add that element of risk to a stock that's not moving or going in your favor, or doesn't give you a reason to take on that risk element of time in exchange for rising profits? So if it doesn't want to do that, then you get out of it. Let's look at some additional trades that have been popping up on my radar. First and foremost, Apple. You got a little bit of like a J hook coming through this 10-day moving average here. It's pretty enticing. So I guess some of you guys could say that you got a bull flag that's forming here, and maybe just breaking out of it today. So this is on the radar. I think there's some legitimacy to this being a good play. You could say that's like a little rising, or I'm sorry, a falling wedge that is getting broken out on. I think that's a very valid argument there as well. And not only that, but you can get it $91 and change, and actually put a stop loss at like just below 89. So Apple is a stock that I'm actually considering getting long on today. I don't think there's as much volatility that we've seen in the past in Apple. I don't expect it to go up to $100 overnight or $110 overnight. I think it's like a steady riser that, you know, if you can get a good, you know, 5 or 6% out of the trade, that's a good trade. You also on the 30-minute chart here with, this is what's sort of nice. We talked about a bull flag / falling wedge on Apple on the daily chart. Now look at the 5-minute and the 30-minute chart. I mean, you got it shooting up and then bull flagging. You got it shooting up and bull flagging there. I haven't looked at the weekly, so let's just do that real quick, just in case wants to give us something else to talk about here. I mean, you could say that's maybe a bull flag. It doesn't look like it really on the weekly, and I don't really see an edge on the weekly, but nonetheless, it's weird seeing Apple at $91 because it makes me think back on like 4 or 5 years ago when I remember like some kind of bad news piece came out on Apple and it dropped to like $77 a share, and I was like, should I pull the trigger on it? Should I buy it? Should I add this to my IRA? And I didn't do it, and now, you know, the rest of the story is, as they should say. Baidu. Now you think, okay, this stock has already run quite a bit. It's broken out of its base and everything else, but look at this thing here. We've got a little bit of a breakout to new highs action going on with Baidu here. That if it can clear the 185.45, 185.50 level again, there's a very good argument that this thing could go straight up to 200 here pretty much in short order. I do like that trade. I'm a little bit hesitant about these kinds of stocks that have made, you know, moves like what we have here from like 150 to 185 without hardly a pullback, because oftentimes what happens is that once it breaks through this resistance level, it'll just come right back down again. But Baidu is a little bit different of a stock. It tends to defy logic a lot of times, sort of like a Netflix stock or a Tesla stock. And speaking of Tesla, you got a ascending triangle pattern here that I really like, that I like a lot. Now, I was telling folks in the chat room this today that this would probably already be in my portfolio. Even though it hasn't technically broken out, it gives a great risk reward. You can put an order in at 238, put a stop loss at 230, and really not take on about 3.5% worth of risk. The problem is that what we have in the current portfolio already it's quite a bit of volatility to it. So you got Facebook, you got First Solar, you got Triple D, and you've got Yoku, all of them with high betas of 2.5 to 3. Tesla has a high beta, so the question really becomes: do I want to add that much beta of additional beta to the portfolio without closing out like a Yoku or a Facebook or a Triple D and a First Solar? And the question is no, because I like those charts just as much as I like First Solar. We already have profits in them, so we're already got something to work with there. Tesla could or could not go, and honestly, I think I'm batting like 250 right now on Tesla trades from this year here. So it's not been my greatest performing stock that I trade in, but nonetheless, it does set up nicely. If it breaks through that 238 level, I would expect that it can maybe see 260 in the near term. And then you got Netflix. And Netflix, you know, it's some nice consolidation. I don't know if this is really quite a ideal trade setup per se, but it is consolidating at the highs of the recent run-up quite well. It's not showing a lot of signs of wanting to give it back, so that's a definite plus there. And you know, sort of like with Baidu, if it can get up to 450 and change, I think there's a good chance that it continues to see its stock price rally as well. So those are some of the ideas. Let me give you guys one more that intrigues me a little bit, is HLF. I haven't talked about it in a while, but we'll just move this thing over here and show you what I'm looking at. You got a huge level of resistance there that it's trying to break through. Hasn't been able to do it with any success going back into May. Actually, going longer back, yeah, since May. So if it can get like up to 66.10 or so, that's about, you know, $1.15 away. But if it can get up to that level, there's a good chance that in the days that follow, this thing could see $70, $75. As always, you got to use tight stop losses. The thought has been that if you have tight stop losses, then you're going to get stopped out more, and that's not true, because tight stop losses makes you focus on better entry prices. I used to swing trade, you know, back in my early days, like 10-15% stop losses. I would stay in these stocks for, you know, ungodly amounts of time because they would never get stopped out, thereby increasing my risk exposure to the time elements and something that could possibly go wrong on the stock. And so really, I didn't see any drop off when, over time I migrated to a much tighter stop loss. In fact, my percentages at calling stocks right has improved with the tighter stop losses, because my entries are that much more important and that much more precise, and I get into these situations that allows me to find the best stock picks out there, and they turn out really well. And if they don't turn out really well, I don't really risk that much in the process. So stick to being diligent with the risk. I cannot stress that enough. I mean, it is the most important element of the trades. There's tons of services out there that will try to sell you on the fact that they have these, boom stock picks or these unbelievable, ways of choosing stocks. To be completely honest with you, success in the stock market has less to do with the stock that you're trading. It has more to do with how you're actually trading it. So if you manage the risk, you'll get the profits. And that's really the biggest lesson that you can take away from this session here, and just from my style of trading. Manage the risk, the profits will come along. So that's going to do it for today. You guys have a great weekend. If you guys need anything, you can always email me, ryan@sharepointer.com. If you haven't subscribed yet, I'd highly encourage you to at least give it a 7-day trial to the SharePointer and Splash Zone. I think you will like it, as many others have. And I'm in the chat room every day from 9:30 till 4 o'clock when the market closes, usually a little bit before and a little bit after. But I'm always in there. I'm always willing to take your questions and to help out in any way, shape, or form I possibly can. So y'all take care. You guys have a blessed weekend, and God bless.